Welcome to the Property Wealth Podcast, where we help you navigate the world of real estate investing. If you're over 40 and looking to build long-term wealth, you're in the right place. Today, we're diving into a fascinating topic: commercial bridge loans for quick deals.
Yeah, that's a great hook, Sarah. A lot of people might not realize just how powerful these loans can be in the right circumstances.
Exactly. They can really open up opportunities for investors looking to move fast, right?
Absolutely. And we'll break down how these loans work, when to use them, and what pitfalls to avoid.
Plus, we'll share some real-life examples that illustrate how others have successfully leveraged these loans.
And let's not forget about the importance of understanding your financial situation before jumping in.
Right. It's all about making informed decisions. And we want to make sure our listeners feel equipped with the knowledge to do just that.
So if you're ready to explore how commercial bridge loans can fit into your investing strategy,
let's get started.
Sarah, when we think about commercial bridge loans, it's really about seizing opportunities, especially for folks over 40.
Absolutely, Mike. With retirement timelines looming for many, the urgency to make smart financial moves is, more pressing than ever.
Right, and let's face it, the current economic climate isn't exactly stable. With inflation rates fluctuating, it's crucial to find avenues that can protect and even grow our wealth.
Yeah, I've been reading about how inflation can really eat away at savings. If you're just sitting on cash, it's almost like losing money.
Exactly, and that's where real estate, specifically through strategies like bridge loans, can come into play. For instance, I had a client, let's call her Jane. She was approaching retirement and felt anxious about her savings not keeping pace with rising costs.
What did she do?
Well, Jane decided to invest in a commercial property that needed some work. She used a bridge loan to get the funding quickly. The idea was to renovate and then refinance into a longer-term loan once the property appreciated.
That's smart. So she wasn't just sitting on her hands, waiting for the market to change, right?
Exactly. She took control of her situation. And, as the renovations progressed, she increased the property's value significantly. When she finally refinanced, she not only secured a better interest rate, but also had a stronger cash flow.
That sounds like a game changer for her retirement plans.
It really was. And it's interesting because many people in that age group, they often think they've missed the boat on real estate investing. But there are still plenty of opportunities out there.
Definitely. Plus, I imagine there's an emotional component to all of this too.
Oh, for sure. Financial security isn't just about numbers. It's about peace of mind, knowing that you're setting yourself up for a comfortable retirement.
Right. Who doesn't want to feel secure as they head into their golden years?
Exactly. And, with the potential for wealth transfer to family, it's not just about you anymore. It's about building a legacy.
Yeah, I think a lot of listeners can relate to that idea of wanting to leave something behind for their loved ones.
Absolutely. And with the market shifts we're seeing, there's a unique opportunity for those who are willing to act quickly. For example, I worked with a couple, let's call them Tom and Lisa, who wanted to invest in a commercial space for their growing business.
How did they approach it?
They found a great property but needed funds fast. They opted for a bridge loan to secure the deal before someone else snatched it up. The speed of that decision allowed them to take advantage of a good market price. And now they're not just growing their business, but also building equity.
It's like a double win.
Exactly. And I think that's a big takeaway for our listeners. Timing is everything in real estate. With commercial bridge loans, you can act fast and capitalize on opportunities that might not last.
And especially in a shifting market, having that agility can be a real advantage.
Right. Plus, with the rise of remote work, there are so many businesses reevaluating their needs. Some are downsizing, while others are looking for new spaces.
So if someone is over 40 and looking at these kinds of investments, they could really tap into that market shift.
Yes, indeed. They can identify properties that are undervalued or in transition. With a bridge loan, they can quickly secure those deals before the competition moves in.
That's such a practical strategy, and it sounds like it's about being proactive rather than reactive.
Exactly. And let's not forget about the emotional side of all this, the sense of control and empowerment that comes from making these strategic financial decisions.
Yes! That feeling of taking charge of your financial future, it's really important, especially as you're thinking about retirement.
And, for many, it's not just about the money. It's about the lifestyle. Investing in properties can provide additional income streams, which can lead to more freedom in retirement.
Right? Like the ability to travel or spend more time with family without financial stress.
Exactly. And it's so important to look at the long-term picture, understanding that these investments can provide both financial and emotional security.
So it sounds like there's a lot of reason to consider commercial bridge loans right now.
Definitely. And as we move into the core strategies, I think it's essential for our listeners to realize that these loans can open doors that might otherwise be closed.
Agreed. Let's dive into those strategies and help them understand how to leverage this opportunity.
So when we're talking about commercial bridge loans, it's really important to know a few core strategies to make them work for you.
Right. I mean, it's about understanding how they fit into your overall investment plan, isn't it?
Exactly. One of the first things to consider is the 70% rule. It's a guideline that says you shouldn't pay more than 70% of the after-repair value of a property. So if you find a commercial property that's worth, let's say, $1 million after you fix it up, you shouldn't spend more than $700,000 on it.
That makes sense. You're essentially giving yourself a buffer for repairs and unforeseen expenses, right?
Absolutely, and that ties into the importance of due diligence. You really want to have a solid understanding of the property's condition before you dive in. Get a good inspector, maybe even a contractor, to give you estimates on repairs.
Right, I've heard that can save you a lot of headaches later on.
For sure. Now, another rule of thumb that I like to share is the 1% rule. It's pretty simple. If a property is priced at $200,000, it should generate at least $2,000 a month in rent. This helps you quickly assess whether a property could be a good cash flow investment.
So you're looking at the rental income in relation to the purchase price. That's good to keep in mind.
Yes, and don't forget about the 50% rule, which says you should expect to spend about 50% of your rental income on expenses, including maintenance, taxes, and management fees. It's a rough estimate, but it helps you calculate your net operating income.
Got it. So if you're bringing in $2,000 a month, you'd be budgeting about $1,000 for expenses?
Exactly. That way, you can figure out your cash flow. It's crucial to know whether the property will be a financial burden or a source of revenue.
Now let's talk about the financing options. What are some things to keep in mind when you're looking at bridge loans?
Great question. Bridge loans are typically short-term, usually ranging from 6 months to 3 years. They can be a bit pricey, often with higher interest rates than traditional loans. So you want to ensure you have a clear exit strategy in place.
An exit strategy, like knowing how you'll pay off that loan when it's due?
Exactly. You could refinance into a longer-term loan once you stabilize the property, or you might sell it for a profit if the market is right. But you have to be prepared for both scenarios.
Right, and I imagine having a good relationship with your lender can help with that too.
Definitely. Building that trust can lead to better terms and quicker decisions when you're in a time crunch.
Speaking of time, how do you evaluate the market conditions for commercial properties?
One key factor is the cap rate, or capitalization rate. It's a way to measure the potential return on an investment. You calculate it by dividing the net operating income by the property value. If you're looking at a property with a net income of $50,000 and it's valued at $1 million, your cap rate would be 5%.
So a higher cap rate means a better return, right?
Exactly. But it's also about context. A property in a growing market might have a lower cap rate because of its potential for appreciation, while a property in a declining area might have a higher cap rate but less security.
That's a good point. You're balancing risk and reward then.
Right, and when evaluating a deal, I recommend creating a checklist. Start with location, property condition, potential income, and market trends. You want to be thorough.
So it's about having a systematic approach to each deal. That makes it less overwhelming.
Exactly. And don't overlook the importance of understanding the local economy. Job growth, population trends, those factors can make or break your investment.
That's so true. I think a lot of people underestimate how much local dynamics affect real estate.
Yes, and it's why networking with local investors or real estate groups can be invaluable. You gain insights that you just can't get from online research alone.
And having those local connections can also lead to potential off-market deals, right?
Exactly. Those can be some of the best opportunities. Just remember to stay patient and diligent. It's easy to get excited about a deal, but you don't want to rush in without doing your homework.
Speaking of that, are there common pitfalls you see investors fall into with bridge loans?
Oh, definitely. One of the biggest traps is underestimating costs. People often think they can just quickly flip a property and make a profit, but unforeseen repairs can eat into your margins.
Yeah, I imagine that would be a real blow to your plans.
It can be. And also, relying too heavily on projections without considering market fluctuations can lead to disaster. Always have a buffer in your financial planning.
That's really good advice. It's about being realistic and prepared for the unexpected.
Yes, and always remember that it's a marathon, not a sprint. Building wealth through real estate takes time, so stay focused on your long-term goals.
Absolutely. I think a lot of people can get discouraged if they don't see immediate results, but it's all about the journey, right?
Exactly. And with the right strategies in place, you can navigate those bumps along the way.
It sounds like a solid approach. I think listeners will find these strategies really helpful as they dive into commercial real estate.
I hope so. It's all about empowering them with knowledge and confidence to make informed decisions.
Well, it looks like we've covered some great ground today.
So, when it comes to commercial bridge loans, one of the biggest pitfalls I see is over-leveraging. People get a little too excited about the potential returns and they borrow more than they can comfortably pay back.
Yeah, I can see how that would happen. It's easy to get swept up in the numbers. But what does over-leveraging really look like in practice?
Well, I once consulted with an investor who had taken out a bridge loan to acquire a commercial property, thinking the rental income would cover everything. But, they didn't factor in the vacancy rates.
Oh no, I can imagine where this is going.
Exactly. They assumed they'd have tenants lined up immediately. But when the property sat empty longer than expected, they started missing payments, which, compounded their problems.
That's tough. So how can someone avoid that kind of mistake?
The key is to be conservative with your projections. Look at the historical vacancy rates in that area, and be realistic about how long it might take to fill those spaces. Always have a buffer,
Makes total sense. What about bad tenants?
Bad tenants are another common issue. They can really derail your cash flow. I had a client who was so eager to fill their units that they skipped over the due diligence part.
What happened?
Well, they ended up with a tenant who was consistently late on rent and eventually stopped paying altogether. It took months to get them out, and during that time, the owner was losing money.
Ouch. So how do you identify red flags when screening tenants?
Look for signs during the application process. If they have a history of evictions or poor credit, that should raise a warning flag. And personal references can be really telling. Don't skip that step,
Right. And what about cash flow? I feel like that's such a crucial part of the equation.
Absolutely. Ignoring cash flow can be fatal. I've seen investors who focus too much on appreciation and forget to ensure the property pays for itself each month.
So what do they miss?
Well, I had one investor who bought a property that looked like a steal, but after expenses like maintenance, property management, and utilities, they were left with nothing.
Wow, that's a harsh reality check.
It is. And the lesson here is to always do a thorough cash flow analysis before pulling the trigger. If the numbers don't add up, walk away.
Got it. What about timing the market? That seems like a tricky game.
Timing the market is like trying to catch lightning in a bottle. I once had a client who thought they could time a purchase right before a boom. They rushed in, but the market took a downturn just after they bought.
Oh no. So they lost out?
Yeah, they ended up holding onto a property that was worth less than what they paid, and it took years to recover. The market's unpredictable, so it's better to focus on long-term value rather than trying to predict the next big wave.
That's a good perspective. So what should investors focus on instead?
Look for solid fundamentals in a property, location, tenant demand, and, potential for improvements. Those are going to serve you better in the long run than trying to time the market.
And what about hidden costs? I can imagine those could sneak up on you.
Oh, absolutely. Many investors overlook things like property taxes, insurance, and maintenance costs. I had a friend who bought a building but didn't realize how much the taxes would increase after the purchase.
That must have been a shock.
It was. Their monthly expenses ballooned, and they weren't prepared for it. They ended up needing to raise rent to cover those costs, which, scared away some of their tenants.
I can see how that creates a cycle of issues.
Exactly. To avoid this, always do your homework on all potential costs, talk to other property owners in the area, and budget for the unexpected.
Great advice. So if someone finds themselves in one of these situations, what steps can they take to recover?
First, assess your situation honestly. If you're over-leveraged, it may be time to consider refinancing or selling the property. And if you have bad tenants, start the eviction process promptly.
That makes sense. Taking proactive steps is crucial.
Definitely. And for cash flow issues, look for ways to cut costs or increase rent strategically. Just be sure to communicate with your tenants about any changes,
Yeah, keeping that line of communication open is so important.
Right. And for hidden costs, it's about being diligent. Regularly review your financials to catch any surprises early.
So it's really about being proactive and informed, isn't it?
Exactly. You want to stay on top of your investments and be prepared to pivot if things don't go according to plan.
Wise words, Mike. So to wrap things up, it sounds like diligence and preparation can make all the difference in avoiding these common pitfalls.
Absolutely. If you keep your eyes open for red flags and stay grounded in your approach, you'll set yourself up for long-term success in real estate.
Well, that's a great note to end on. What's next for our listeners?
I think they should take a moment to reflect on their current strategies, maybe even jot down any potential red flags they've encountered. Being proactive now can save a lot of headaches later on.
Sounds like a solid plan.
All right, so let's dive into some immediate steps that our listeners can take right now.
Yeah, it's all about actionable advice, right? So what's the first thing they can do?
Well, I'd say start by checking out some online resources. Websites like Zillow, they can give you a good overview of property values in your area. It's a great way to familiarize yourself with what's available out there.
Absolutely. And if you're looking for something more specific to investing, platforms like BiggerPockets have a wealth of resources. Their calculator tool is fantastic for analyzing potential deals.
Right. And it's user-friendly, too. You can plug in numbers and see if a property makes sense for you financially. Plus, they have forums where you can connect with other investors.
Connecting with others is so important, especially if you're just starting out. What about local MLS access?
Yes, definitely. If you can get access to your local multiple listing service, that's invaluable. It gives you real-time data on properties that are on the market, which is crucial for spotting good deals quickly.
And speaking of spotting deals, tools like DealCheck can help you analyze properties quickly, right?
Exactly. DealCheck lets you run numbers on potential investments, and you can even compare properties side by side. Super helpful when you're trying to make decisions fast.
I love that. And for those who might want to check out rental income potential, Rentometer is a great tool. It helps you see what similar properties are renting for in your area.
Yes, that's a must-have for anyone considering rental properties. Understanding the rental market can make or break your investment decision.
And let's not forget the power of reading. Any book recommendations?
Definitely. The book on rental property investing by Brandon Turner is a classic. It really breaks down the process and offers solid advice for beginners.
Oh, I've heard good things about that one. And what about podcasts?
Well, apart from ours, of course. BiggerPockets podcast is a fantastic resource featuring interviews with successful investors sharing their insights and experiences.
Great choice! And listeners can also join local meetups or real estate investment clubs. It's a great way to network and learn from others who are also in the trenches.
Yes, starting small can really add up. Maybe set a goal to analyze one deal per week. It doesn't have to be a big deal. Just get comfortable with running the numbers.
Right, and it's all about building that habit. The more you practice, the easier it gets.
Exactly. And don't forget to track your progress. Keeping a journal or a spreadsheet of the deals you analyze can help you see patterns and learn over time.
That's a smart idea. And for those who might feel overwhelmed, it's totally okay to start where you are. Take it one step at a time.
For sure. Even if it means just taking a few minutes each day to read an article or watch a video on real estate investing, just keep that momentum going.
Yes! Small, consistent actions lead to big results over time. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
Well, Sarah, as we wrap this up, I think there were some really valuable insights today about commercial bridge loans.
Absolutely, Mike. First off, one of the biggest takeaways is how these loans can provide quick access to funds. That's crucial for anyone looking to seize investment opportunities fast.
Right. And then there's the flexibility they offer. You can use them for various purposes, from buying properties to renovations.
Yeah, and let's not forget the importance of having a solid exit strategy. Knowing how you plan to pay back that loan is key, especially in a fluctuating market.
Exactly. And of course, understanding the costs involved. It's not just about getting the loan. You need to factor in fees and interest rates.
Those can add up, for sure. But when strategically used, these loans can really help accelerate your journey in real estate investing.
It's all about building that long-term wealth, isn't it? Real estate can be a powerful tool if you approach it wisely.
For sure. And it's never too late to start, especially for those of us over 40. Every step you take can lead to significant growth over time.
So if you found today's episode helpful, do us a favor. Like, subscribe, and drop a comment. We'd love to hear your biggest takeaway or any questions you might have.
Yes, and share this with someone who's also looking to invest in property. You never know who might need that nudge.
And next time, we're diving into SBA loans for real estate investors. These can be game changers for anyone looking to expand their portfolio.
Can't wait for that conversation. Thanks for joining us today, everyone.
Yeah, it's been a pleasure. Keep investing wisely.
Until next time, take care.